What's going on, YouTube? It's Matt Fairclough. Welcome to Mentorship Monday. My partner in crime, Justin Fraser. Come on in, Justin.
Hey, Matt. What's happening, man?
That's how we do it. Let's bring on our first question. Ask.
Awesome. So great to be here. So great to be here. Thank you, Matt. Thank you, Justin.
Reframe it. You don't have to read off the screen there. Tell us what you were thinking.
Yeah, well, so, and this comes from personal people in my network that I've started to kind of, they know what I'm doing now, real estate investing, and, I've got, some background in it, and a lot of family history in it, but, everyone, when it comes to actually going from great idea to here's thousands of dollars and to for you to invest, on my behalf. And one of those people I talked with recently, I honestly asked them, hey, I'm going on this show, and what would you be interested in? And they're like, how are you going to not lose my money?
How to not lose money? Let's talk.
Yeah, right. Because right. So, and on the other side of that, so that's from the investor, someone who's going to be forking over that money. They're like, I don't want to lose it. I want it to grow, of course, but that fear instinct of, well, like it might just get lost. So how do you mitigate that? What are you going to do to ensure that I'm not going to only lose my money? Then on the flip side, on the general partner, on the investor, who's doing the deals, it's like, well, then what can I do to not just reassure them and just kind of tell them a good spiel, but to actually have a plan in place, and how can I go into deals knowing that, hey, this actually is, I have a pretty high confidence that this actually may work out, and how can I do right by these investors the best way that I can?
Okay, cool. So two different questions really, and that's totally fine. So LP side due diligence to make sure they don't lose money, and GP side business planning and integrity to make sure you don't go losing people's money, right? Mm-hmm. Okay, cool. All right, come on in, Justin. Let's start. So here's LP side conversation first. Well, let's me and Justin do the LP side, and we'll do the GP side. Cool. LP. It's all about ensuring two things: what's the downside risk, and what's the collateral. Okay. So how bad could things get? For a syndication, the worst thing that could happen in most syndications is you don't get the preferred return you thought you were going to get when you were going to get it, and the project has to defer the pref for a little bit and you get caught up. The probability of losing the site altogether is fairly slim, if not zero. This happens on the GP side too. People get caught on the upside. They're like, oh man, I can make 15% return. And right. And GPs want to be like, I'm going to get you a huge return on your money, double digits. We're going to apartment buildings, cash flow, taxes. Right. Yeah. But they don't spend enough time. We do, but people don't spend enough time talking about what could happen and what the other side of it is. So LPs need to get focused on, what's the downside risk and can I pallet it? And it's likely not going to be that you're going to lose all your money and this deal is going to go bankrupt. That's possible, but it's probably not anywhere near in the realm of possibility in today's world. Banks don't want these properties back. And unless you invest with a bad actor, like someone who's literally out to steal your money, odds are you're going to get your money back one way or another. It's just the worst case really is that the delay on getting your money is going to be out there. So if you're an LP and you need that cash flow, syndications are probably not for you unless you want to get to something that's like pref equity or high security. Making sure what the downside is, and if there is collateral, what can I come and get that's like something that I can hold as a place marker to get my money back, like a mortgage on a property or whatever. If it's equity, there's really not a whole lot there aside from the GP, the sponsor's reputation. Justin, what are your thoughts on how an LP can make sure they don't lose their money, but also just make sure that they are getting into something that's worth that is what they think that it is?
Yeah, the answer to both of these questions, it's like one side of the line is one way and one side of the line is the other, but it's like the same answer either way. You want to look at the sponsor's reputation. You want to know, like, have they done this before? So if we're projecting 90% returns on our next deal, well, we've never done 90% returns before, as much as I would love to, right? It's just so out of the blue that I would not trust me if I tell you you're going to get 90%, unless there's a very, very clear business case, right? So you want to see what have those deals done before? What has that sponsor done? You want to vet that track record. You want to know that they've been successful. And, it is a good question to ask, what is the worst case scenario? Because if you say, well, worst case scenario, I mean, I love all the answers, right? There's tons, but, I get asked a lot, what if the place burns down? I say, well, that sucks because that's someone's house, where someone's living, but we're well insured from a financial standpoint. The morality of like someone's home burning down aside, you're protected, right? We have great insurance coverage with an umbrella policy on top of it, and like all these extra layers of security. It might delay a return, it might change how it gets spent out, but we're well protected there. So it's even the whole building going down. There's all these safeguards put in place. It really comes down to the worst case for every individual deal, and a lot of times it comes down to the sponsor. Is the sponsor going to run this deal well? Something I preach out on my show, True Multifamily, all the time, which is you have to run your assets well.
Plug.
You have to run your assets well, because that's the difference between driving an asset into the ground or excelling it and hitting the returns projected by the underwriter.
Nice. And I think that the worst case scenarios that most people think are possible are really not possible. Like as Justin said, what if the property burns down? Well, as long as nobody dies, then you got insurance. And God forbid if somebody dies, God forbid, there's ramifications on that too. And that's also what insurance is for. I hate to say that, but it's
covered. I mean, we do have coverage for all of that kind of stuff.
Yeah. And that's the thing. So people tend to worry about, what if you can't raise rents? What if you can't do this? What if you can't? Like there are stopgaps for those things. And if your syndicator, created enough worst case scenario into their underwriting and into their conservatisms, then you'll get through all those things. So I
have a question for Justin though. Were you asking? You said LP and GP. Were you thinking more in terms of syndication, or because your next question is about how you can raise money? Are you thinking about something smaller like a fix and flip or something more local?
Yeah. So the bigger game is the bigger multifamilies down the road. I mean, currently I have 3 properties. One's 2-bed, 1-bath little house. One's a 3-unit, and the other is a 7-unit. And so as you can see the progression there, moving up and gradually getting larger multifamilies, and also just on our end, we're starting to hit that limit for our own funding. So it's like, hey, in order to really scale and go bigger, I realize, I'm going to need to partner to really go bigger in the future. And so that is kind of the trajectory down the road.
Yeah. So good stuff. And I mean, my first GP deal was 2 single family homes, so it doesn't have to be a, big old apartment complex. It can be whatever it is, but the GP has fiduciary duties and the LP has fiduciary duties too, right? They both have their homework they should be doing. So forgetting about the size of the deal for the GP, and to reframe it here, you want to talk about, let's touch on this. You want to talk about how the GP can make their investors comfortable that they're not going to lose their money, get their money stolen, right?
Yeah, and kind of throughout from A to Z, from kind of initial conversation of, here's an opportunity that has come my way, here's a track record, and that initial kind of offering or that invitation to that conversation to, okay, hey, some skin in the game, and then they're like the day before the skin is going into the game, and it's like, oh, what if, right? That stuff comes in, rolling the eyes like, oh yeah, that's happened, right? And then midway into it, something, because in construction or with any project, something's going to happen that is going to change the game plan.
Something will happen, and I'm sure that it will.
And not only, it might happen like 2 or 3 times, or more, right? By the time you get to the finish line,
everything's going to happen.
And so, just going on that journey with people, and obviously communication is going to be super key. That due diligence, like you're saying, is really knowing those numbers, knowing the track record, having a great team, things like that. But kind of going through that journey of from the beginning, that conversation, to when skin's almost going to the game, to kind of that things have now shifted, and now we gotta, it's not going to look like we expected, and just managing those emotions essentially from A to Z.
All right, let me unpack a bit. Okay, a few things I'm going to touch on. about, like, when you're talking to investors, what you really ought to be talking about, all the versus what people think that you should talk about, and also skin in the game, right? So those are some like pieces of what you just said that I want to, like, throw out there, right?
Okay.
Number one, when folks that are presenting to an investor, they think that they need to be like, I've got the most amazing return. It's 18, 19, 20% and all the money you're going to make. That's important to investors, but it's not first, second, or third. They want to really, they put stuff in the LP. Are you going to steal my money? Is this deal overbaked? Am I taking a risk? Whatever. That's the conversation they want to have, is about collateral risk, those kinds of things. Additionally, I find my investors like it when we actually do this whole thing called giving a shit. Okay. Meaning, like, caring about them at all. Hey, how old are you? Where are you from? How old are you when you go retire? You do what for a living? I've talked to investors that I was supposed to be talking about the deal that we were getting into. I ended up talking for a half an hour, what they did for a living. People do interesting stuff.
Yeah,
and
it's fun.
Care about them, legit, not like acting like you do. Oh, that's interesting. Tell me more about what you do. No, they care. Tell, like, just like I said, give a hoot, man, about what they do, and also about their financial goals and how many kids they have, all that stuff. When you're going to college, and this isn't just about caring. This is also collecting data that you can help them get where they want to go if you can get that data. Where are the kids graduating high school is a fact that would be wonderful to know, because if their kids,
motivation,
right? But if their kids are 15 and you're putting them into an investment that's got a 7-year lock, they should know right out of the gate. Hey, man, listen. So whatever you ink a check for right now is going to be gone for 7 years, right? And I can make returns on it. But if you're planning on being Johnny's first freshman year at Harvard. So it's important to collect that kind of data. That's number one, is to, as a GP, care about them and their goals and understand them and communicate with them from that fashion. The second thing is, every investor loves to ask about the skin in the game. And sometimes me and my GP team, we have skin in the game. Sometimes we don't. And you can either decide one of two things. Just have skin in the game, and it's easy to answer. Like, oh yeah, sure, I've got 50K, or I've got whatever in the deal, or be really good at explaining why skin in the game doesn't matter, which is, it really doesn't. But make sure that be prepared to answer that, because it comes up all the time. How much money do you have in? What would
interject? No matter what, don't lie.
We'll
find out. Right?
Yeah.
At some point, someone will find out. So, because you'll be saying one thing to one person, you'll forget that little lie you told about, oh yeah, I got 50K in there, and then you'll forget, right? So if say what's true,
hard to keep track of lies. Yeah, exactly. It's important to just tell the truth,
But if that's a legitimate concern that you have, or that your investors have, that you don't have any money in the game, well, let's think about what we need. We need a general partner to have skin in the game, so we could bring in someone that's going to invest, but they're in as a GP as well. Maybe they're doing other things that add value, and now the general partnership is investing in the deal.
Well, what I always quote is how much our general partnership has in the deal, because it doesn't matter really how much you personally, Justin, have in the deal. It matters how much the leadership team of the project has in the deal. And that's an easier number. And it's also a more impressive number to quote, because if you've got EMD in the deal, earnest money deposit down, and you have the property under contract, you've got to have EMD, and it had to come from somewhere. And if you're giving somebody equity for their contribution or fronting that EMD early for you, then that's now a part of the leadership team. And you're not BSing. They're one of your partners now. They didn't just loan you the money. They are one of your partners. You could say the general partnership team has X. That is not a lie. That is the truth, right? Now, if you make up a number and just say, several $100,000, that sounds like a lie, But you can tell the truth in those fashions if you talk about your entire general partnership team. The other thing you can do, which is what Cedric here is at. Cedric, my buddy here, is asking, right? What do I say if I don't have any funds to put in the game at all? Fair enough. You could say, well, Mr. Investor, guess what? I may not be inking a check like you are, but I've got my reputation, a personal guarantee on the mortgage, sponsorship. I've got probably several years worth of my life invested in this company to get things to this level. So I've got quite a bit invested aside in time and reputation and resources. And Mr. Investor, did you know that there's something called a bad actor clause that says that if I end up on like just sneezing the wrong way on this deal and getting fined, or the SEC gets involved in whatever in this investment with you, I cannot syndicate again. Did you know that? You know? So I have my career on the line. Okay. As a syndicator. So it's, yes, a check is valuable, but everything I have on the line is just as valuable too. And I would be leery working with investors that put their check above everything else that you were producing for them. Okay. So yeah, that's the whole, I know that wasn't directly, but that's,
that's great.
And that's skin in's a big conversation. So
it really sounds like knowing the people and knowing who they are, what their values are, what their goals are, and it will really help to determine, well, is this even a great fit for them? Is this gonna, which then, because down the road, if at the beginning, like you mentioned, Matt, with, if this is going to get locked up for the next 7 years and you might really need it in 5. So is this really the best fit for you? But actually, down the road, we got this other deal that's in the pipeline that actually might be an even better fit for you and your goals.
I redirected many investors to other things that we have to offer. And I've told dozens and dozens of potential investors that had a lot of money out to invest with us that we were not the right fit for them. Because I felt like they maybe, a lot of times as their goals weren't aligned, they wanted this, we wanted that. I was like, listen, I could probably force a square peg into a round hole and convince you that this is the right deal, but guess what? This ain't gonna work. And other times I just you kind of sometimes smell high maintenance on investors. And if you want to scale, you got to work with people that are going to trust you to do what you do, and they're going to go do what they do, and you go do what you do, and they take your updates and they ask questions, and then they go back to letting you do what you're great at,
And the backside to that is communication.
Yeah,
leading up to close, through close. Like we did, just for example, on this last deal we did webinars like every week leading up to closing. Like, here's the latest numbers from the property. Here's the latest that's happening with COVID in North Carolina. Here's the latest with this. Just keeping people informed about everything that was happening. And then 1 month in, which we've never done, we did a webinar 1 month in and say, hey, here's what happened 1 month in. Our financials aren't even finalized yet. And we're giving you a preview of everything that's been happening, just to ease concerns, because a lot of people are concerned because of COVID. A lot of people are concerned about eviction moratoriums and this and that. And so we have to over communicate so that people feel comfortable. And the more over communication we do on this deal, frankly, will lead to more investment on the next deal.
Yeah.
Right. Yeah. Integrity and trust. And if they trust you throughout that process and you do a great job, well, then the repeat business and the relationship just keeps going.
Absolutely.
Yeah.
No, thank you so much for having me. This was wonderful, and looking forward to next time.
No problem. Thanks for watching, guys, and have a great and profitable week.